Treasury gold must be revalued from $42 to market. And for US Treasury gold to mirror or equally globally fungible Basel III NSFR compliance, billions of non-Basel III compliant unallocated FX OCC bets have to be bought back at market. So as soon as the Treasury gold revaluation account is marked to market, every other central bank will do exactly the same. Thereafter, the US will join every other central bank that is already benefiting from a higher gold price. And liquidity providers estimate most likely gold will rally to a realistically plus or minus $8,000 fair value per ounce.
Gold prices have climbed more than 25% year-to-date, fueled by strong safe haven demand amid escalating tensions in the Middle East and renewed uncertainty surrounding President Donald Trump's aggressive trade stance. Although prices stabilized somewhat in June, central bank demand, particularly from China, continues to provide firm underlying support for the market. AndrewMaguire notes that developed central banks are once again turning to physical gold, while exchange-traded funds are attracting long-term institutional investors. He argues that the U.S. Federal Reserve remains one of the last major forces actively suppressing gold prices, highlighting that the official U.S. Treasury gold is still marked on the books at just $42 an ounce. According to Maguire, a revaluation is not only inevitable, it could be the catalyst for other central banks to follow suit. The People's Bank of China recently resumed gold purchases following a 6-month pause in 2024, which had temporarily interrupted an 18-month buying streak. Analysts interpret this renewed buying not only as a hedge against monetary instability but as a strategic move to further distance China from dollar-denominated assets. According to the World Gold Council, global central banks added 244 tons of gold to their reserves in the first half of 2025, with Turkey, India, and other emerging economies leading the way. Despite sanctions on Russian gold, market liquidity remains robust. Data from the London Bullion Market Association revealed a 12% year-on-year increase in daily gold trading volumes in June, an indicator of deepening institutional demand. Maguire believes that a revaluation of gold is inevitable and that it will fundamentally reset the current financial system. He suggests that, based on existing market dynamics and sustained central bank demand, the revalued gold price could reach around $8,000 per ounce. JP Morgan projects that gold could exceed 7% of China's total foreign reserves by the end of 2025, further strengthening the resilience of its balance sheet. As Maguire puts it, when this global repricing of gold unfolds, the United States will be forced to catch up. At that point, gold will no longer be seen merely as an investment. It will form the backbone of a new monetary framework. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Central banks now officially hold more gold than they have ever held since 1970s. It's well illustrated there. However, what's not reflected here is that a large percentage of central bank gold reserves bolster military assets. And as such, real gold assets are as closely guarded as a secret as weapon systems and strategies. And this is why official reserves do not include unreported BRICS, which is primarily Russian, Chinese, and Saudi, 400-ounce monetary gold accumulations, which also picked up significantly in March 2022. So not including what is secretly held by the Chinese generals, empirical evidence suggests that in aggregate, including the 2,292 officially held reported gold that China owns, Beijing has salted at least 35,000 tons of gold inside the state-held banks. I'm not alone in thinking that. That is widely held view from anyone that's connected to China. And in addition, there's 31,000 tons of official Chinese citizens' gold that they own. Now, in fact, that exceeds that of India's private holdings, which is about 30,000 tons. So it's now exceeded that. Now, while there have been multiple Indian government attempts to incentivize their citizens to lend their gold, deposit their gold into government-sanctioned lease buyback structures for the purpose of their governments, what do you think? Leasing into the market to protect the foreign, as part of their foreign exchange strategies to maintain the value of the rupee. All of these efforts have failed to attract any interest. Why? Because Indian people are too savvy to be suckered into that. Whereas if we compare that into the very real threat of a US-China, South Seas, Taiwan war, should Beijing need to bolster their already large gold reserves, as we saw trial ballooned in 2023, which we covered in an episode back then, Chinese citizens' gold could be patriotically leased into the state with the PBOC assurances it would be equitably returned at a higher price. In other words, an investment choice. As such, in a time of war, Chinese physical reserves could amount to a massive 70,000 tons of gold. That is a huge number of accruing of gold. And also for the same reasons, the 2,330 tons of officially reported Russian reserves are also grossly underestimated, more likely closer to 12,000 tons. In aggregate, current BRICS countries hold in excess of 10 times as much gold as is held by the US Treasury. However, while BRICS gold is fully fungible and 100% Basel III compliant because it's physical and it's deliverable and fungible, US Treasury gold is reported to be directly linked to these billions of the likely rehypothecated, unallocated OCC bets, which is currently in the late stages of being stick-handled by Citi and JP Morgan. In fact, the only global central bank left fighting a rise in the gold price versus the dollar is the Fed. And as we've just witnessed into Monday's most recent OCC mark-to-market event, billions of dollars of non-Basel III compliant, unallocated FX gold derivatives had to be squared. However, with less speculators left to wash and rinse these liabilities into physical demand, it's all about to change. Now, add in a late in the day reconversion to gold by developed market central banks. That's undoubtedly going to push gold higher. And here, have a look at the sheet here. And really, retail buyers are only just waking up to gold as a safe haven alternate to US Treasuries. With many funds not mandated to own physical gold, they have to buy an ETF. So US-facing gold ETFs have actually started to attract very sticky long-term investment demand that is very difficult to rinse out in traditional ways. So in order for the Fed to unwind its impossible to maintain gold pricing efforts, there's only one solution. Treasury gold must be revalued from $42 to market. And for US Treasury gold to mirror or equally globally fungible Basel III NSFR compliance, billions of non-Basel III compliant, unallocated FX OCC bets have to be bought back at market. So as soon as the Treasury gold revaluation account is marked to market, every other central bank will do exactly the same. Thereafter, the US will join every other central bank that is already benefiting from a higher gold price. And liquidity providers estimate most likely gold will rally to a realistically plus or minus $8,000 fair value per ounce. I think best thing to, let's just pop in to the charts for a second, because I think it illustrates it so much better. Now, with that in mind, into this big gold rinse, let's look at the bullish silver structure. Now, for that, we're looking at the futures chart, which is currently trading at around about an 17 or 18 cent premium to spot. That will reduce to at par with spot towards the end of the contract. It started off at about 53 cents to premium. So just to understand that this is a futures chart. This is where all the gaming occurs. So that's why we look at that. So let's look at this bullish silver structure, which also exposes the Fed to undeliverable OCC bets that they're also trying to square. And if you remember in our last episode, which was recorded one day after the silver options bet was squared, in fact, around about here is when we recorded that, these official OCC bets were driven down to the exact 35.20 sweet spot. I mean, right to that level. Sweet spot in spot was exactly 35.54 in futures. And what did we see? Immediate short covering And we looked at it last time, but just really bringing your attention back to it. So the gold short rinse efforts into OCC that's being squared on the 30th evidenced another round of insider short covering in silver. And this was a coal-driven discount. Insiders knew to buy this back up. Reason being, with COMEX silver market paper settled liquidity alongside producer financing initiatives leaching out into the Chinese physical exchanges, silver has now largely escaped the LBMA stranglehold. And these same actors are having difficulty in containing silver, which has not fixed below spot 36 since the 5th of June. We would view any offers to sell silver at current levels as a stacker's opportunity to load up.
AndrewMaguire notes that central banks now officially hold more gold than at any point since the 1970s. However, the numbers released to the public likely understate the accurate scale. A significant portion, especially in nations like China and Russia, is believed to be tied to military or strategic reserves, held off the books, and guarded with the same secrecy as national defense systems. James Rickards has echoed this view in past interviews, citing strong evidence from Chinese mining output, import records, and direct insight from Swiss refiners who supply bullion to China. Rickards has met with top Chinese gold banks and confirms that gold accumulation is being coordinated at a strategic level, sometimes even involving the People's Liberation Army. The objective is to build reserves without alarming markets or driving prices up. The BRICS alliance is taking a methodical approach to gold accumulation. Like disciplined stackers, these nations are increasing their holdings while avoiding market disruptions. Their aim isn't to reintroduce a nostalgic gold standard, but to create an economic framework that offers strategic independence. Maguire estimates that China may already possess up to 35,000 tons of gold held by the state, with another 31,000 tons privately owned by citizens. In a crisis or wartime scenario, the government could access those private reserves, bringing China's total potential gold stockpile to nearly 70,000 tons. Such a vast accumulation speaks to the growing global shift away from reliance on the dollar and toward tangible, unprintable assets. Let's get back to the interview.
BRICS summit just ended on Monday, and it elicited a pushback from Trump, who came back saying it was anti-American, et cetera, and talking about putting some big tariffs on the BRICS nations. But in keeping with the overall BRICS mandate of essentially taking barriers down and to empower multipolarity, the focus of the BRICS summit has been really on accelerating financial multipolarity, now facilitated with the expansion of the new development bank, the NDB, bolstering its intra-BRICS national currency trades benchmarked to a weight of gold. Even secondary, more everyday general BRICS pay transactions, which are not directly backed by a weight of gold, are settled within the BRICS clear system, where the FX value of each nation's currency is weighted by the percentage of gold backing up that currency. So with gold markets now being discovered in Asia, as Bloomberg recently drew attention to, it provides the BRICS autonomy. Now, Dilma Rousseff announced she came out, in fact, before the BRICS started. She announced the new development bank had launched a multi-billion-dollar investment fund. Now, you know where that's coming from. Now, Russian Finance Minister Anton Siluanov confirmed that the NDB is formalized as a BRICS sanctioned tariff-proofed cross-border settlement hub. They knew that the tariffs were coming. It's very important that they bypass SWIFT. And so this is backed up. This program is backed up with loan guarantees for mega infrastructure projects across the BRICS sphere. So in other words, you don't have to go borrowing money from your enemy. So in short, with 85% of the world's population and rising economic weight, Trump's tariffs are really driving BRICS nations to actually consolidate resources. And the NDB will provide the necessary financing. And there's a lot of instruments under this initiative, huge initiative here. Now, there's a lot of public information available here. And this covers BRICS Pay, BRICS Gold-Backed Unit, the loyalty, the business version of BRICS Pay, and the upcoming loyalty programs. It's worth having a dig into this. It's publicly available. Gold, bottom line, is strengthening the BRICS currencies at the expense of the dollar. We also expect a new BRICS currency bill note to be launched. It was shown in front of the camera. Now, as gold is already being discovered in the Eastern physically backed markets, the formalizing of the financial infrastructures to support liquid global settlement is the final piece of the puzzle. And it will actually be the death knell for the COMEX if it doesn't become Basel III compliant. We've got Singapore, we've got Shanghai, Hong Kong, Russia, Brazil, Africa, Southeast Asia. They've got sufficient physical market liquidity to benchmark physical gold price discovery and to set gold on the decentralized, trustless blockchain rails, valuing the gold price in real time and based upon real supply-demand fundamentals. This is what we've all been wanting the West to do for 50 years. Now, the BRICS nations in aggregate have accrued sufficient physical market liquidity to benchmark a self-arbitraging, fungible gold price for trade of a T+1 settlement, but it's actually going to be T+0. This 7-second settlement process will be set on the already tested 40% backed decentralized sanction and tariff-proof blockchain rails. Every single gold settlement transaction will be Basel III, first year, a high-quality liquid first-year asset, and fully compliant. Otherwise, it wouldn't be fungible. And this is a real global price discovery process. And as it gains liquidity, it will push back against the underpriced, paper-diluted Western exchanges. And while these bullion presented at the local London fixes is actually Basel III compliant because it has to be deliverable, these benchmark fixes currently only discover a small percentage of all of the CMA LBMA transactions. This is about to change. And as liquidity migrates into the globally fungible T+0 physical exchanges, a real supply demand will emerge and it will backwash into the FX fixes. So China's cross-border payment system, the CIPS, already interconnects 4,900 banking institutions. And while ignored by the mainstream media, it's not gone unnoticed that the Chinese SIPS platform overtook SWIFT transactions in May. So to sum up, this current paper-driven gold price suppression leg has really just opened one more opportunity for us all to join what every other central bank is doing, swapping, depreciating, debasing fiat currencies to load up on physical gold and silver, this time into bargain basement prices. And just look at the open interest level at this point versus the 800,000 contracts that were open in 2020, and look at the gold price now, and look at the lack of interest now. When you consider that some 30,000 of this 445,000 lot open interest is actually momentum shorts that will get rinsed. So the open interest here has risen into short sellers and will easily be rinsed. And if you look, we've been following this for a long time, each Bank of International Settlement repayment, bar for a couple, have been paid at higher and higher and higher prices. And despite every effort here, the BIS repayments were still repaid at a very similar level to that was repaid at the end of May. So at the end of June, we see them being repaid again without any discount. They're looking for discounts. And this continues all the way up. So with what we look like, what we figure is another higher stair step, it's time to look at what to expect into the third quarter.
Amid rising geopolitical turbulence and persistent monetary shifts, a quiet but seismic transition is unfolding beneath the surface of global finance. While headlines focus on inflation data and trade policies, a growing number of nations are stealthily reinforcing their economic defenses with vast quantities of gold, some disclosed, others hidden. This isn't merely a hedge, it's a calculated challenge to fiat dominance. As strategic reserves swell beyond publicly acknowledged figures and the mechanics of financial power realign, the precious metal long dismissed as archaic may soon stand at the core of a redefined economic order. Could the next global monetary reset be triggered not by a crisis, but by the silent accumulation of gold in vaults far from the dollar's reach? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.